As a smart money concept trader, one of the key decisions when entering a trade is selecting the optimal entry point, typically between the fair value gap and the order block. This requires careful analysis to ensure you're positioning yourself in a high probability area for price action to align with your trading strategy. By choosing between an order block and a fair value gap as the entry area, three types of risk are imposed on our trade. Choosing to trade at a fair value gap instead of an order block carries the risk that price may reject the gap and move toward the order block, potentially hitting your stop loss. This could occur if the fair value gap fails to attract sufficient market interest and price shifts to fill or react at the order block instead. If we choose to enter the market based on an order block instead of a fair value gap, there is a possibility that the price could reverse upon reaching the fair value gap. This means the price might change direction before triggering our trade, potentially causing us to miss the entry. For this reason, traders often choose the fair value gap as an entry point and set their stop loss just below the order block. This strategy typically results in a low risk to reward ratio, as the potential reward may not outweigh the risk taken. If the market moves against their analysis, the trade could result in significant losses, making this approach inherently riskier. The main question now is which area represents the optimal entry area for the trade, the order block or the fair value gap? An order block is a significant area where institutional traders have previously entered the market in large volumes, causing a substantial price movement. Order blocks are essentially areas of consolidation or price indecision, typically occurring before a large move. Versus a fair value gap is a price gap or imbalance between two price levels, often after a strong move in one direction. These gaps usually appear due to an imbalance between buying and selling pressure and can act as a target zone for price to return to and fill. To determine which area to choose for entry, we must first understand whether the market movement is driven by orders from institutional traders or by an imbalance between buy and sell orders. When both an order block and a fair value gap align, it's important to consider the order flow and market context to determine the most likely point of entry. The order block typically represents a stronger level for entry because it signifies institutional buying or selling activity. Order blocks often have a higher probability of producing a reversal or a strong reaction. If price approaches both an order block and a fair value gap, the order block may take priority for entry, especially if it is near a key swing low or high, major support or resistance, or has been tested multiple times in the past. A fair value gap is a price imbalance, and price often returns to fill these gaps. However, it is not as definitive as an order block, since it represents more of a zone of potential price action rather than a clear indication of institutional buying or selling. If the fair value gap is very close to the order block or overlaps with it, the market may first target the fair value gap before bouncing off the order block. If price is in a strong trend, the fair value gap might get filled first. Then the order block will provide a more refined point of entry after the retracement. Please look carefully at the chart below. You can see that the order block and the fair value gap have formed consecutively. Additionally, you can observe that the price changed direction after passing through the fair value gap and encountering the order block. As we mentioned before, when an order block and a fair value gap form consecutively, order blocks often have a higher probability of producing a reversal or a strong reaction. However, this is not the only reason for the price reversal from the order block. The market formed a liquidity sweep and then shifted its market structure. The order block that formed is right after a swing low. This pattern clearly indicates market control by institutional traders. Of course, it's not always necessary for a liquidity sweep and market structure shift to occur. If an order block and a fair value gap form consecutively after swing highs or swing lows, the probability of the price rejecting from the fair value gap and reversing from the order block increases. In a strong, bullish or bearish trend, the fair value gap might get filled first, as the market retraces to fill the imbalance before continuing in the direction of the trend. In this case, if both the order block and fair value gap align, you could favor the fair value gap for a short-term retracement and wait for confirmation, like a candlestick pattern or momentum signal, at the order block to enter. In a ranging or potentially reversing market, the order block would be a better choice for entry, as it represents institutional interest and is likely to signal a reversal or continuation of the existing range. The fair value gap in this case would be more of a secondary zone to monitor for price action clues before entering off the order block. A trending market refers to a market condition in which prices are consistently moving in one direction, either upward, bullish trend, or downward, bearish trend, over a period of time. A trending market is characterized by sustained momentum in a particular direction, as opposed to a sideways or range-bound market where prices fluctuate within a narrow range. In a bullish trend, prices are consistently rising, characterized by higher highs and higher lows. In this scenario, buyers are in control, and market sentiment is generally positive. In a bearish trend, prices are consistently falling, characterized by lower highs and lower lows. In this scenario, sellers dominate, and market sentiment is generally negative. As previously mentioned, in a trending market, a fair value gap is generally a more suitable area than an order block, until a pattern emerges that indicates the entry of institutional traders into the market. A ranging market, also called a sideways market, is a market condition where the price fluctuates within a specific range, moving between established support and resistance levels without a clear upward or downward trend. A potentially reversing market refers to a situation where a trend, either upward or downward, may be losing momentum and could be about to reverse direction. A reversal occurs when the price starts moving in the opposite direction of the previous trend. The reason for the formation of a ranging market is the presence of orders from institutional traders. In a ranging market, there is a higher likelihood of the price breaking through the fair value gap and activating trades in the order block. Simply put, when we observe a trending market with consecutive highs and lows, it's because the market doesn't have an opportunity to correct, and one side of the trade, either the buyers or the sellers, is in control. In this case, the fair value gap can be considered an entry zone for a trade. However, when the market enters a ranging phase and forms liquidity areas, it becomes clear that institutional traders have entered the market. In such situations, the order block becomes a more suitable entry zone. I hope you found this video helpful. Please like and subscribe to our channel.